Well, we're still talking about the markets. I'm being joined now by Eremonsele Aziba. He's an investment analyst with AfriInvest as we turn our attention to developments in the fixed income segment of the market. Good morning to you, Eremonsele.
Good morning, Harriet.
It's great to have you on the program. Talk to me about what you've noticed about the bonds and the bills markets this week.
Well, what we noticed is from the start of the week, we had bearish sentiment in both the bonds market and the T-bills market up until Wednesday when we had the DMO auction, about 120 billion worth of bond instruments. There was actually a new issue of the July 2021 instrument that we saw. And what we noticed in the bond auction was there was actually an oversubscription across all instruments, given the relatively attractive yields that are currently prevailing in the market. But we also noticed that there was an under-allotment of this new issue. The proposed issue was about 40 billion, but only about 30 billion was actually issued, while the 2036 bond instrument, which was also oversubscribed, was overallotted in order to somewhat cancel out the impact of the undersubscription at one end. So there was to sort of cancel out the underallotment at one end. There was an overallotment at the other end to maintain that 120 billion worth of bonds that was planned to be raised. And from what we noticed, if you look at the range of bids for most of these instruments, the range was between about 10% and 17%, which is also indicative of the fact that investors are pricing in the higher inflation figures that we've seen into their investment decision. And this was what triggered the higher yields that we saw at the auction. But following the auction on Wednesday, we saw an upturn in performance as yields, there was renewed buying interest, and we saw yields decline on Thursday, and we expect this trend to continue today in the market.
Well, that will be a little interesting, especially since we're expecting the National Bureau of Statistics to release the inflation figures for the month of June. Anytime now, this weekend is where we're going into. What are your expectations, especially since it seems investors have kind of priced those numbers into how they trade at the market?
Our expectation for inflation is that for the month of June, we should see a marginal increase in inflation rate from 15.6 that we had in May. We project an uptick to about 15.7, as we're expecting higher increases in both sub indices that contribute to the general inflation level. We're expecting an uptick in the core sub index, generally pressured by higher energy prices that we noticed in the month, and also in the food sub index, as the foreign exchange illiquidity challenges that we've had have continued to pressure higher imported food prices. So we're expecting to see an uptick in inflation rates for the month of June, though it won't be as large as what we noticed between April and May. But we're expecting an uptick. And as a result of this higher expectation of higher inflation, there are also expectations that at the next MPC meeting, there's also a possibility of the MPR rates being raised.
Well, Eremonsele, a lot of people will actually argue that with you, because in the last few meetings, there really hasn't been any change with regards to the monetary policy rate, and maybe not at this time we will be seeing it. But fingers crossed on that one. And I know you folks will do a survey to try to get to feel the pulse of the market. But before then, and still taking a look at the bonds market, following the bonds auction, we noticed that offshore buyers were not so dominant in that segment of the market. It seems as if it was mostly domestic buyers that actually bought into the bonds market.
Sorry, I didn't quite get you, Harriet.
Okay, well, going back to the bonds market and still talking about the results that we got from the auction, analysis shows that according to FV Inquest, that offshore buyers were notably absent from the bonds market. So it seemed as if it was more domestic players that we had in that segment of the market.
Well, we know that the major players in the bonds market is actually the domestic players, accounting for about 80% of participation in the market, you know, with the likes of the PFAs and the domestic fund managers. And if you remember the delisting of the Nigerian bonds from JP Morgan Emerging Markets Index, which was closely tied to the FX illiquidity challenges that we're having, we saw a lot of foreign investors actually attempt to repatriate their funds and leave the market. But with the recent introduction of some flexibility in the market, we believe foreign investors are still waiting on the sidelines to actually see the modalities of this market and the operations and see transparency and also see if the illiquidity issues have been addressed before they make moves to come back into the market. So this is basically what we have noticed. Foreign investors are still waiting on the sidelines to see the developments in the FX market and how they will play out before coming back into the market.
So this will basically shape how we're going to see next week more of a bearish mood from all investors and even analysts alike.
Well, you know, like I mentioned, from yesterday, we already saw some renewed buying interest in instruments in the bonds market. There's a likelihood that this may actually continue in the coming week as investors search for value in instruments.
Aaron Monsela, thank you so much for joining me on the program and sharing your perspectives with us.
Thank you very much.
Business Morning returns in just a moment. Join us again.